Good day, everyone. Good day, sir. We are the group 4. Our topic is about stock valuation. So I am Regina S. Omnos. Together with me is Althea May Nano and Jeve May Paalaman. So, share screen sa ako. Okay, so before we proceed to our topic about stock valuation, Um, let's have a recap about the previous report of the Group 3, which is about bond valuation. So, bond valuation is a method to calculate the present value of the expected future returns, earnings, or cash flow from a bond investment. An investor who invests in a debt instrument such as a bond uses the valuation method to determine whether the cost of the bond is worth the returns over time. So this means that bond valuations assess an investor in deciding whether the future yields from the bond investment are suitable for their portfolio. Thus, an investor determines the value of a bond through its trading prices, interest rate, and par or face value, while the bond's interest rates and par value remain the same. Changes occur in the bond prices and investors' returns over time. Now, I will let Althea May Nano introduce the stock valuation.
Okay, so good morning once again. So I am Althea Making Nano, and my part is to introduce about stock valuation. So valuing stocks, it is essentially the process of computing the market value of a company and its stock price. So before we go through, we will gonna define first what is a market value of the company and what is the stock price. So first, let's go to the market value of the company. So market value of the company, it is also known as OMV or the open market valuation. So open market valuation, it is the price on an asset that would fetch in the marketplace or the value that the investment community gives to a particular equity or a business. So further explanation to that, market value is easiest to determine for exchange traded instruments such as stocks and futures since their market prices are widely disseminated and easily available. But certain for over-the-counter instruments like fixed income securities. So, however, the greatest difficulty in determining market value lies in estimating the value of liquid assets like real estate and businesses, which may necessitate the use of real estate appraisers and business valuation experts respectively. So on the other hand, we will go to stock price. So let me tell you one of the best kept secrets of the stock market. So we cannot we cannot earn more money from our investment in a company than the cash that the company pays out to us or to those people who work on in the company. So mostly dividends and eventually some liquidation value over its remaining lifetime. So how could it be otherwise? And we all know that no company lives forever, right? So the profits it generates are valuable to us only if they get paid out to us before the company's stock price hits zero. And to that, owning an individual stock should be somewhat riskier than owning debt of a solvent government that can print the currency with which it will pay you back. So let's continue. This method aims to compute the future value of stocks in the most practical way, incorporating some or all relevant factors that affect stock price. So there are different ways of valuing stocks. One of the most common and practical ways of valuing stocks is the market valuation. So the market valuation So we are going to find out capitalization is equal to the stock price multiplied by commonly used to refer to the market capitalization for a or of a publicly traded company, and it is calculated by multiplying the number of its outstanding shares by the current share price. So next slide, Raj. So we have here an example. So it is an example about market valuation. So on 21 November 2018, Telco Company ended the day with a stock price of 100 pesos. Telco Company has total outstanding shares of 1 million as of the same date. So how much is the market capitalization of Telco Company? So in here, in the problem, we needed to compute or to find the market capitalization of the said company, or specifically the Telco Company. So next slide. So in the given problem, so we have the stock price, which is 100 pesos, outstanding shares of stock, which is 1 million pesos. So we can easily determine the given stock price and the outstanding shares of stock if we know how to understand the problem. Okay, so we will gonna apply those values in the given formula. So we have, what is the formula? So we have market capitalization is equal to the stock price multiply or times the outstanding shares of stock. So we have market capitalization is equal to 100 pesos multiply 1 million. So it is equal to 100 million pesos. So let's go to the next. So we have future free cash flow. So represents the excess cash after a company spent for its capital expenditures. So the values in the computation of the future free cash flow are usually taken from a company's statement of cash flow. So this financial statement summarizes the movements of the company's cash. The cash flow statement details the cash improvements that could be from operating activities, financing activities, or investing activities. So in here, wait lang ha. So we will gonna determine first what is a cash flow, because we stated here about cash flow, diba? So the statement of cash flows can provide this type of information. So it is important as it can give an overview that other income statements or balance sheets cannot. So it can also um, provides what or why they are important in assessing the financial strength of an organization. So in the future free cash flows, we have a formula. So we have future free cash flow is equal to cash flow from operating activities is equal to capital expenditures. Again, understanding the problem is very important to this, because if we don't know how to understand the problem, we cannot identify those values that is being needed. Okay, so let's proceed. Next slide. Let's go to the present value of a stock. So in the present value of a stock, it is the value of the stock today that is worth more than its value in the future. So the formula to calculate this is as follows. So before that, I will gonna give another definition to that. So present value states that an amount of money today is worth more than the same amount in the future. So in other words, present value shows that money received in the future is not worth as much as an equal amount received today. So calculating present value involves assuming that a rate of return could be earned rather on the funds over the period. So we have this. formula in present value of a stock. So present value of a cash flow at year or the N, which is N is the number of years in the future, is equal to CF at year end. So CF is the cash flow. So cash flow at year and number of years in the future over the quantity one there is constant. We were gonna add 1 plus the discount rate of the required rate of return or the R with the exponent of N na to. So N is the number of years in the future. Next, Next is the cost of capital. So cost of capital, the discount rate in the stock valuation, which is essentially the funds being allocated to finance a business. Another is that imputed cost of capital is usually derived from the likelihood or extent of risks that a company may encounter. So capital is the heart of a business, right? So every decision is taken based on the capital. So the financial managers must think about the cost of capital and the expected rate of return while choosing a project for investment. So the cost of capital is a bridge between the firm's decision of investing in a long-term project and the assets owned by the stockholders. So it really plays a vital role to decide whether a proposed investment will push up or push down the firm's stock price. Next is the perpetuity value. So a perpetuity value, there is usually a period where the calculation is set, say 10 or 15 years. This number of years represent a lump or the sum value for all free cash flow. So a perpetuity in finance refers to a security that pays a never-ending cash stream. So it is essentially an annuity with no termination date. So, perpetuities today are uncommon financial products, but the concept of a perpetuity is nonetheless important in finance. So next, so we have the perpetuity value. We have a formula again in the perpetuity value. So it is computed as perpetuity perpetuity value is equal to CFN, which is CFN is cash flow in the last individual year estimated, multiplied to 1. Again, 1 is constant. 1 plus G. G is the long-term growth rate, okay? Over R minus G. So R is the discount rate or the required rate of return. So to compute the estimated stock price or the intrinsic value of a company, we will gonna add the discounted value of free cash flow for the time period stated in the problem and the perpetuity value. So that's all in my part, and I will now give the floor to Miss Regina Omnus.
Okay, thank you for that comprehensive discussion of your part, Miss Althea Maynano. So here we have another example, example 7, which is the discounted cash flow valuation. BCD Corporation, a relatively new company engaged in the development of mobile applications, has the following statements of cash flow from year 2020 to 2024. So here in the table, as you can see, this is the statement of cash flow from 2020 to 2024. Values shown are in million pesos. Now, in the first column, we have net income, cash flow from operating activities, capital expenditures, capital flow from financing activities, and then the last is cash flow from investing activities. We have the same day, a month, but different in years. Now, using this table, we're gonna have to compute the following: the future free cash flows from 2020 to 2024, projected average growth rate from 2020 to 2029, future free cash flows from 2025 to 2029, discounted future free cash flows from 2025 to 2029, perpetuity value, uh, intrinsic value, nagdoble ni siya. This is discounted perpetuity value. Perpetuity value. Okay. So, Miss Jevime Paalaman will discuss the solution or the computation from A to D. Okay. All right.
So, in letter A, we are going to compute the future free cash flows from 2020 to 2024. And this is how we get the result. So future free cash flow is equal to cash flow from operating activities minus the capital expenditure. So ato siyang i-base atong table nga pakita ni Miss Nos. So I'll share my screen for the solution. So to calculate we're going to calculate the future free cash flows using the formula that akong giingon ganina. Starting from 2020, as you can see in the table, ang cash flow from operating activities in 2020 is 15. Then the then the capital expenditure is 3. 15 times 3 is equal to 12. Next is the 2021. The cash flow from operating activities in 2021 is 30 minus the capital expenditures, which is 6. 30 minus 6 is equal to 24. In 2022, the cash flow from operating activities is 45 minus the capital expenditures, which is 9. 45 minus 9 is equal to 36. In 2023, the cash flow from operating activities is 60 minus the capital expenditures, which is 12. 60 minus 12 is equal to 48. And last, in 2024, the cash flow operating activities is 75 minus the capital expenditures, which is 15. So 75 minus 15 is equal to 60. So this is for letter A, the result in future free cash flows from 2020 to 2024. So as you can see, sa 2020 to 2024, inyong lang taon ng ilahong answers, murag kung ano siya, ga-add ra siya og 12. So 12 plus 12, 24, 24 plus 12, 36, 36 plus 12, 48, and 48 plus 12 is 60. So sa letter B, we are going to calculate the projected average growth rate assuming the same trend will continue up to year 2029. This will be the basis in computing the future free cash flow for the next 5 years, 2025 to 2029. So atong kwaon ang 2020 to 2021 sa. So this solution kay ato siyang i-base sa ato ang letter A. 24 minus 12 is equal to 12. So this will become 24 because as you can see in 2021 sa letter A kay 24 ang iyahang result. Sa 2020 kay 12 pud iyang result. So 24 minus 12 is equal to 12. This is the 12 in future free cash flow. After ani, kay atong kuhaan ang ilahang percentage. So 12 divided by 12. 12 divided by 12 is equal to, kung inyo siyang i-compute, pag result, kaya mahimo siya 100%. So, muna siya sa 2020 to 2021. Next is from 2021 to 2022. So as you can see here sa ato ang letter A, ang 2021 2022 is 36. Ato siyang i-minus sa 2021, which is 24. It will become 12. Then we will divide it by 12 divided by 24. Divided by 24 is equal to 50%. Next is the 2022 to 2023. So 2023, we got 48 minus 36 is equal to 12. Then 36, 12 divided by 36. So 12 divided by 36 is equal to 33.33%. In 2023 to 2024, 60 minus 48 is equal to 12. Then divide it by 12 divided by 48. So 12 divided by 48 is equal to 25%. 25%. Next is the 2024 to 2025. So 2024 to 2025, we got 72 minus 60 is equal to 12. As you can see, dire kaning 24, 36, 48, 60, 72, nag-check 72 kay ato na siyang gikuanan og giplasan og 12 for the 2025 year. So we have the next is we are going to divide 12 divided by 60. Divided by 60. So 12 divided by 60 is equal to 20%. Next is the 2025 to 2026. In 2025 to 2026, we're going to subtract 84 minus 72 is equal to 12. Then divide it by 72. 72. 12 divided by 72. So 12 divided by 72 is equal to 16.67%. Next is the 2026 to 2027. In 2026 to 2027, we have to subtract the 96 minus 84 is equal to 12. Then divide it again. The result is 83. 12 divided by 83 is equal to Sorry, this is 84, not 83. 84. 12 divided by 84 is equal to 14.29%. 14.29%. Next is the 2027 to 2028. We have 108 minus 96 is equal to 12. Then divide it by 96. 96 divided by 12. 12 divided 96 is equal to 12.50%. And last is the 2028 to 2029. 120 divided by 108 is equal to 12. Then divide it by 108. 108. 12. 12 divided by 108 is equal to 11.11%. So after getting the percentage in each year, we are going to total the percentage increase from 2024 to 2029. Since nakuha naman nato ang sa letter A sa 2021 to 2024, so kanina po natong kaan og total percentage. I mean percentage increase. Yes. So we have to add starting from 2024, 2020 to 2025, 20%. Sorry. Oh, average growth rate is equal to 74. Ay, so ato siyang kuag ato siyang i-plus ang sugod sa 2024 to 2029. So 20% plus 16.7 16.67% plus
Ma,
14.29 14.29% plus 12.50% plus 11.11%. So, pag imo ni siyang i-total ning 5 kabuok percentage, we got is equal to nasa ko? We got 74.57. So, after that, divide the total by 5 years to get the average growth rate. So, ito siyang divide og 5. Divided by 5. To divide as na siya of 5. 74.57 divided by 5, the result will become 14.91%. So in letter B, this is our average growth
Excuse me,
rate.
sa Jeb. Di na siya makita. Gamay na kayo.
I'm sorry.
Ana.
Kita
Sige.
na. Kita na? Klaro na?
Bakla, bitsa. Luwis na kayo siya mukhang blurred. Maklaro na ni mo, tiya?
Dili siya pwede makuan ka ng ipatakilid. Dili. Na ma-rotate siya ba?
Oh,
Kuha
landscape.
man siya. Ito nang gamay kayong cellphone.
Pero try daw.
Gagani, try the landscape job.
Ka na.
Ito na dahil.
Oh.
Sige ko.
Nakita si Damhanan.
Ana.
So as you can see, ato paghuman nato og add sa 5 kabuok result, 5 years kabuok result nilang percent is with a total of 74.57. Then we divide it by 5 to get the average growth rate which is 14.91%. So let's proceed to letter C. Future free cash flow. We are going to compute the future free cash flows from 2025 to 2029. From 2025, so in free cash flows for 2024 is equal to 60 million pesos. In our average growth rate kay katong 15%. Sorry, wait. So ato ni siyang i-round off, this will become 15%. So atong average growth rate is 15%. So to convert 15% into decimal point, it will become 1.15. So 60 minus 1.15 is equal to 69. Next is 2026. 69. Ang result na to, diri ato na po siyang imbutang sa 2026. 29 minus the growth rate, 1.15, is equal to 79.35. 79.35. Then in 2027, the result sa 2026, which is the 79.35 minus the growth rate, 1.15, is equal to 91.25. In 2028, 99.25 divided by the growth rate, 1.15, is equal to 104.94. And last is the 2029. 104.94 minus the growth rate, 115, is equal to 120.68. So, after getting this 2025 to 2029, assuming 20% cost of capital, the cost of capital or discount factor for the year 2025 to 2029. So, ito na po kung ilang cost of capital or the discount factor for the year 2025 to 2029 Japon. So, in 2025, we'll start from 1. 1 times 120 1 times 1.20 is equal to 1.20. So, hindi mo siya 1.20 because sa akong ginunyan niya, assuming 20%. Sa 20%, when we convert it to decimal point, it will become 1.20. So, 2025 got the result 1.20. 1.20 in 2026, 1.20. Okay mo man siya yung result sa ato ang 2025. Times 1.20 is equal to 1.44. In 2027, 1.20, 1.44 to. (1.44) minus 1.20 is equal to,
Multiply siya, Jev.
I multiply the answer. 1.44 times 1.20 is equal to 1.728. 1.728. In 2028, 1.728 times the 1.20 is equal to 2.0736. 2.0736. So in 2029, 2.0736 minus times 1.20 is equal to 2.48832. So this is the future free cash flows from 2025, namely dire. And this in the other 5 sa ilalom kay the cost of capital or discount factor for the year 2020 to 2025. So next is, we're going to proceed to letter D, the discounted future free cash flows from 2025 to 2029. Stop share ko. Stop share ko.
Stop share.
Wala na ni.
Makita akong screen?
Yes, Reg.
Oo, sa PPT. Kuan ko no, i-share screen po na imuha, Jev. Sa D naman ta.
Share screen. Wait lang ha.
Kaya ang formula.
Sa letter D na ko.
Oo.
Sige, go.
So in letter D, the discounted future free cash flows from 2025. Balik sa lunch.
Sige.
2025 to 2029 using this formula. So discounted FCF or the future free cash flows is equal to future free cash flows divided by the quantity of 1 plus R. R is our cost of capital or requires rate of return. Exponent n. So atong n is the number of years in the future. Gosh, I don't know my screen. So in letter D, 2025. So ang ato ang future free cash flow is 69. So 2025. Then I divided by 69 divided by ano siya mo nudge eh? Ay. 69 divided by the quantity of 1 plus 0.2. Itong 0.2 is the cost of capital requires rate of return. Exponent 1 is equal to so 69 1 plus 0.2 exponent 1 is equal to 1.20 and 69 divided by 1.20 is equal to 57.50. 57.50 in 2026. No more na, no more. No more na. So, 2026 naman tadali 79.35. So, ito yung butang date sa 2026 ay ang 17.35. 79.35 divided by 1 plus 0.2 0.2 to the exponent of 2 is equal to so kung imong isolve ni 79.35 divided by 1 plus 0.2 squared, it will get 55.10. 55.10. In 2027, let's proceed to 2027. So, atong 2027 dito sa letter C. Wait lang. 2027 na siya 91.25 na result. So, itong ibutang dali is the 91.25 divided by the divided by 1 plus 0 plus 0.20. 2 di ay. 0.2. Sorry. Exponent 3. So the result of this will be 52.81. So 2027, 52.81. And let's proceed to 2028. So 2028, sa atong letter C, we got the answer. We got the result 50.61. Wait lang, ito na siyang unahan. Mag-proceed man siya sa denominator. consistent kay gyapon ni siya nga formula. Ang mao sobra kay ang iyahong n, which is the number of years in the future, kay magka-increase man siya. So sa 2028, 4 na po ni ang iyahong n. So atong numerator ani is the result sa 2028. 104.94. So the result ani is equal to 50.61. 50.61. Then the last one is the 2029 year. So 120 1 plus 0.2. Then atong ani is 5 na. Then the numerator would be the result, the answer in 2029, which is the 120.68. Then the result of this is 48.50. So this is for discounted future free cash flows from 2025 to 2029. So as you can see in the table, ikaw na po, Reg.
Okay, so here, this is the alternative solution. Wait, mapaan ko sa akong PT? Okay. So here, this is the alternative solution. So discounted future free cash flows is equal to future free cash flow over cost of capital or discount factor. Now, another table. So first column is the future free cash flow, cost of capital or discount factor, discounted future free cash flow. So this year 2025 to 2029. All right.
So
Okay.
as you can see in the cost of capital or discount factor, katong sa ako ang gisolve, ang iyahong denominator, muna siya result, muna nakakuha ka otong 1 point, muna nakakuha ta sa 2025, natay cost of capital is 120, 1.20, and 2026, 1.44, and in 2027, 1.728, and 2028 is 2.0736, and 2029 is 2.48832. So that's all for my part.
Yes. And also the discounted future free cash flow. Kung unsa to mga na-obtain nga value mo ay atong gikuan diri sa year 2025, 2026, 2027, 2028, and then 2029. Okay, so let's compute the perpetuity value. Assume 5% as the long-term growth rate and compute for the perpetuity value. Apply the discounted future free cash flow derived for the year 2029, which is 48.50, and the discount rate of 20%. Using the formula for perpetuity value, we have here perpetuity value is equal to CFN times 1, or quantity of 1 plus G, all over R minus G, where CFN here is the discounted future free cash flow derived for the year 2029, and then our G here is the long-term growth rate, and then our R is the discount rate. Now, using the math type app, using the formula perpetuity value is equal to, here the fraction, C CFN times quantity of 1 plus G over R minus G. So for the given, we have CFN is equal to 48.50 based on the table. And then G is equal to 0.05, which is the growth rate in the problem, which is the 5%. And then in decimal form, we have 0.05. The same with discount rate. R is equal to 0.20. Now, since na atong given, so ato na siya i-substitute sa atong formula. So, perpetuity value is equal to 48.50, no, 48.50 times quantity of 1, which is the constant, 0.05 all over 0.20, which is our discount rate minus growth rate, which is 0.05. So, atong unahon ang naa sa quantity, copy ang 48.50, 1 plus 0.05 is 1.05. Saan nalimtan na ni? $48.50 1.05, and then 0.20 minus 0.05 is 0.15. Therefore, we obtain the value of 339.50 pesos for our perpetuity value. Now, let's move on to the computation of discounted perpetuity value with the formula discounted perpetuity value is equal to perpetuity value all over the quantity of 1 plus R with the exponent n. N is the number of years in the future. Again, let's use math type. So, our formula is discounted perpetuity value is equal to perpetuity value over quantity of 1 plus R exponent and number of years in the future. So, let's substitute. since we already have the value of perpetuity, then 339.50 is here. Then our denominator, substitute na to is 1, which is the constant, and then our R is 0.20. And then for our N, which is the exponent, then, oh my God, dali siya nga exponent. Since, anong na 5 siya, kay from 2025 to 2029 man siya, so 5 years. And then, is equal to, copy, 339.50, I know, 339.50, and then 1 plus 0.20 to the power of 5, we have 1.20. So, we obtain a value of 136.44 pesos for the discounted perpetuity value. Now, let's proceed to the intrinsic value, computation of intrinsic value. Now, to compute the intrinsic value, we need to add the discounted future free cash flow for 5 years from 2025 to 2029 and the discounted perpetuity value. So, we have here intrinsic value is equal to 57.50. So, kani siyang 57.50 is gikan ni siya sa table, kani, discounted future free cash flow. 57.50 plus 55.10 plus 52.81 plus 50.61 plus 48.50. Dayon, i-plus na to ang value nga na-obtain nato from kaning discounted perpetuity value, which is 136.44. Dayon, ang atong nakuan nga answer is 400.96. Now, let's compute the value per share. So, to find the value per share, assume that BCD Corporation has outstanding shares. The company's stock currently owned by all its stakeholders of 1 million. So, we have the formula here. Value per share is equal to intrinsic value divided by outstanding shares of stock. So, using the math type, so using the formula value per share is equal to intrinsic, ano ni siyang inani iyahang typing, intrinsic value divided by, dire na lang ta, divided by outstanding shares of stock. Now, the value of our intrinsic is 4,960,000 pesos divided by 1 million. So, we obtain 400.96 pesos. So, this is the value per share. So, the discounted cash cash flow valuation of BCD Corporation is 400.96 pesos, right? So, which means that if their stocks trade more than this amount, the stockholders will gain. If the stocks fall below the amount, the stockholders should already be cautious. Even though the discounted cash flow valuation of stocks is more reliable way of measuring stocks, this does not guarantee that the future value will be exactly the same as projected. Financial analysts and investors still put a safety margin to counter against fluctuations that were not covered in the computation. Now, another stock valuation model that calculates the true value um, of a company through dividend payments is the dividend discount model. So this valuation model is used because of its credibility of showing the actual earnings distributed to the stockholders. The present value of dividend payments can be a reliable basis in computing the company's future worth. The formula to be used in determining the value of the dividend payments in the future, assuming that there is zero growth, is as follows. So here, we have the formula P sub 0 is equal to dev times 1 plus g all over r minus g, where P sub 0 is the price at time 0, and dev is a dividend, and then r is the discount rate or required rate of return. Assuming that the company will pay dividends indefinitely, you will need to apply the formula for perpetuity as follows. So we have here P sub 0 is equal to div sub 1 over quantity of 1 plus r plus dev sub 2 is equal all over quantity of 1 plus r squared plus to the equals to dev over r. So where p sub 0 is equal, or the price at the price at time 0, and dev sub 0 is the dividend for year 1, and dev sub 2 is the dividend for year 2. And then R is the discount rate or required rate of return. And there will be times when the company is already stable and constantly pays dividends that are growing every year. The constant growth model should be applied as follows. So P sub 0 is equal to dev times 1 plus g all over r minus g. P sub 0 is equal to dev over 1 plus r plus dev times 1 plus g all over 1 plus r squared plus dev times 1 plus g squared over 1 plus r cubed plus so on is equals to dev times 1 plus g over r minus g, where p sub 0 is the price at time 0, dev is the dividend, g is the growth rate, r is the discount rate or required rate of return. So I think that's all for the discussion of our topic about stock valuation. And I hope you learned something. So again, I am Regina S. Omnos.
And I am Althea making Nano.
And I am Javame D. Paalaman.
And we are the group 4. So bye everyone. God bless.